So welcome to this, one of the very last sessions of the Civil Society Forum of this fall's meetings. My name is Deborah James, and I'm the Director of the International Program at the Center for Economic and Policy Research. We are a DC-based Washington think tank that focuses on providing research and policy about the most important issues of people's lives, both domestic issues as well as international. And quite a bit of our international work over the last many years has focused on the IMF and its policy implications, particularly for developing countries around the world. So we're very happy to continue what is one in, it seems like a series at this point, of discussions actually with the IMF about current policies and their implications, particularly in the crisis period. So today we will be talking about the issues as weaknesses appear in the global economic recovery. There's increasing debate over whether governments should continue or in some cases even increase stimulus spending or begin reducing their deficits and public debt. This session will look at this issue in the context of current policy, both in developed and developing countries, taking into account the different circumstances such as current levels of public debt and deficit, and the strength or weaknesses of the economy. The basic question will be, is macroeconomic policy worldwide generally moving in the right direction? So we are very happy to have here today Petya Kueva-Brooks, who is the Division Chief of the World Economic Studies Division at the International Monetary Fund. And we also have Mark Weisbrot, who is the co-director, an economist at the Center for Economic and Policy Research. And we're going to go ahead and start. Thank you.
Thank you very much, Deborah. Thank you, Mark. Perhaps I could start by telling you a little bit about what we do and what we do in my division and also in the research department, and then move on to the topic which we have for the day. I come from the research department and its wing, which deals with multilateral surveillance. As you know, the fund conducts bilateral surveillance with all of its member countries. But in addition to that, we also have the responsibility of looking after multilateral surveillance. And in that context, one of our flagship publications is the World Economic Outlook. And my division produces that outlook, just so that you may have seen this. It's basically this book. But why am I bringing this up? Because we have this occasion every time when we look at the forecast and we look at developments across the world. We also have the opportunity to examine the type of policy economy has come out of its very deep downturn. And things are proceeding pretty much as we had expected, which is, they're not, the recovery that we're seeing is actually still very fragile, and it is very uneven one. And we see this if we just look at the advanced economies and also some emerging and developing countries who experienced sharp, very deep financial crises. These economies are coming out of the recession at a very sluggish pace. And at the same time, we see a lot of emerging and developing economies where the recovery, the rebound is actually quite robust and is going at pretty good rates. Now, the question is, where do we go from here? And can this sort of pattern which we're observing now go on? And what are the type of risks which we see? And I think the important thing to keep in mind is the following. In a way, what we really need to happen is, at a global level, is that we've seen that the recovery so far in both advanced and emerging economies, to a large extent, has been driven by the very large and very substantial policy stimulus that governments across the world have provided over the past year and a half. And that has really increased the importance of public demand in driving the recovery. That, together with the turning of the inventory cycle, really what's been driving growth in a lot of the advanced economies over the recent quarters. But this sort of thing comes to an end. And then the question is, what comes next? So what we need to see is rebalancing from activity which is dependent on public demand to economic activity which is based on private demand. And in a way, the type of cycle that you want to see is to have this initial stimulus, to have the inventory adjustment, and all of this over time to translate into higher investment as firms start to increase their capacity. What you want to see afterwards is that higher investment translates into more jobs, higher employment growth. And then the step after that is that you want to see that those jobs translate into higher consumption by individuals. And this cycle, the one that I just mentioned, in many ways has gone quite well in many emerging markets. I mean, if you think of Brazil, for example, or if you think of some of the economies in Asia, we've seen kind of the whole pattern. We've seen the higher investment, we've seen the higher consumption. But we've not seen this in many, not most advanced economies, especially the large ones. Kind of the part which is getting a little bit stuck is the investment. I mean, we've seen the increase, but perhaps we should have expected even bigger increase at this stage. And what we have not seen is that all of this makes a difference. We've not seen a big difference in terms of the job market. Unemployment rates remain very high in many advanced economies. And therefore, the type of consumption that we've seen in many of these economies has been, to a large extent, boosted by these temporary stimulus measures rather than being entrenched. And this is a process that we want to see to be completed. So this is what we call the internal rebalancing. Then there is another aspect of this, which again is important for the whole global economy, which is the external rebalancing. We know that prior to the crisis, there were quite a few countries where consumers overborrowed, they overspent, they had very large current account surpluses, and on the other hand, you had other countries, especially some in Asia, but also in Europe, if you think about Germany, for example, that had very large current account surpluses. So going forward, of course, with the crisis, these kind of got compressed a bit, but they're still quite large. And the question is, what should we expect going forward? If the advanced economies, the ones who suffered a lot of these banking crises, are not going to have the demand or the type of demand that they had in the past, which is, by the way, what we show in the analytical chapters in this World Economic Outlook, then the prospects for high growth on a sustained basis in a lot of the emerging economies that depended on exports to drive their growth is not going to be there either. So this really puts on the table a whole set of different issues in terms of what type of policies, macroeconomic policies, but also structural policies are needed to facilitate that rebalancing process. So this basically brings me to perhaps the main message that we have, is that both rebalancing acts are proceeding very slowly. And if they keep doing if policies keep doing what they're doing now, we are going to keep seeing a recovery that is sluggish, that is fragile, and that is unbalanced. So what we need is, in a way, adjustment in policies. We need stronger policies to give us this stronger growth. Excuse me. Now, what do we have in mind here? Help achieve this internal rebalancing. First one is monetary policy, and I would say this is actually the one policy that has perhaps done the most, or has reached its limits the most among the whole set of options. Central banks in advanced economies and also in many emerging economies had lowered interest rates. In advanced economies, they're close to zero. They've also used quantitative measures to stimulate activity even more. And in some cases, there are questions about whether there are limits to this. We think that these accommodative policies should stay in place, and it's very important that they are there in the foreseeable future, especially in advanced economies that are also facing the need for large fiscal adjustments. And we also see room, if needed, to do further quantitative measures. But here, we should just be realistic about what such measures could achieve. If we look at long-term interest rates across the world, especially in many advanced economies, they're already at very low levels, including for large firms. Slightly different story for small and medium-term enterprises, but in principle, if you just look at the numbers, you will see that there may not be that much there may not be that much room to lower interest rates further. So again, the bottom line here, we should just be realistic about what this could achieve. The second policy, and normally maybe 3-4 years ago, I wouldn't be talking about financial sector policies as the macroeconomic policy. But I think what we've learned from this crisis is that financial sector is just so critical, and these financial macro linkages is so important that actually I would put the financial sector policy as economies, they're close to zero. They've also used quantitative measures to stimulate activity even more. And in some cases, there are questions about whether there are limits to this. We think that accommodative policies should stay in place, and it's very important that they are there in the foreseeable future, especially in advanced economies that are also facing the need for large fiscal adjustments. And we also see room, if needed, to do further quantitative measures. But here, we should just be realistic about what such measures could achieve. If we look at long-term interest rates across the world, especially in many advanced economies, they're already at very low levels, including for large firms. Slightly different story for small and medium-term enterprises, but in principle, if you just look at the numbers, you will see that there may not be that much there may not be that much room to lower interest rates further. So again, the bottom line here, we should just be realistic about what this could achieve. The second policy, and normally maybe 3-4 years ago, I wouldn't be talking about financial sector policies as the macroeconomic policy. But I think what we've learned from this crisis is that financial sector is just so critical, and these financial macro linkages is so important that actually I would put the financial sector policy as important as monetary policy in terms of supporting this transition from publicly driven demand to privately driven demand. And why is that? I mean, we've seen that now a lot of banks have been recapitalized. We've seen a lot of injections in financial systems across the world. But we do know that the restructuring process has been going at a painfully slow rate. And in many economies, they're still weak banks, they're undercapitalized banks, and what this is affecting is credit growth, perhaps not at a generalized level, but it is affecting credit supply for certain segments of the economy. And the one that comes to mind immediately is small and medium-term enterprises. And these are usually the enterprises, at least in the US, that provide a lot of at the margin, are responsible for a big chunk of the employment growth. So getting credit to flow, to be available to these enterprises, we think is very important. Now, in Europe, we also see a lot of, we see pockets of banks and various institutions which also face problems. And those issues came to the forefront in past months. Now, there are steps taken to resolve them, but I think, the general feeling here is that one can do a lot more to actually resolve the issues and to get, again, the recovery going. Then in the financial sector area, also another aspect is this uncertainty about regulatory reform. There have been various proposals on the table. There have been some steps taken in this direction to increase capital and liquidity buffers. But the residual uncertainty that is there about the timing and the precise parameters of this is also something that, if resolved, I think is going to help this rebalancing act that I was talking about. And this all brings me to fiscal policy, and I'm going to spend a bit more time talking about fiscal policy. The thing that's really missing, and the thing that we think is the most important one, is to have credible medium-term plans to establish fiscal sustainability, especially in advanced countries. What we've seen as a result of the crisis is that debt levels have reached extremely high levels in advanced economies. And the stimulus which was provided over the past year at a global level, something that we at the IMF called for, this global stimulus to basically prevent the global economy from going into a depression-like scenario, is actually can explain only a very small part of this increase in the debt level at the global level. The main responsibility for this is very simple. It's just the collapse of output in advanced economies, which we saw as a result of the crisis. And in many cases, there were also asset price booms that were accompanying the period prior to the crisis. And when asset prices are now at a lower level, what this means is that their revenues, which were there in the past, and they're not going to be there in the future. And again, this is another reason why debt is so much higher. So now we're in this difficult situation where you have to solve a problem which is there. I mean, when we also think about the age-related spending, which is coming up in a lot of the advanced economies, the challenge becomes really, really daunting. So the question is, what do you do about this? When in the short run, you have a recovery which is fragile, which is not completely well established, and on the other hand, you have this need to adjust your fiscal balances over the medium to long run. So we think that the solution in general, and there are always exceptions here, and I'm going to talk about those as well. The general solution is that it's important to just explain to markets and explain to people how you're going to get this deficit, how you're going to get the deficits, and how you're going to get these high levels of debt to a sustainable level over the medium run. And various things can be helpful there. One is to have medium-term frameworks where you have some sort of commitment and some sort of plan, not only about a year or two, over 3 years, over 5 years, and explain exactly how you're going to do that. And the other, what could also be helpful is to have fiscal institutions, independent fiscal institutions that increase the credibility of the forecasts and kind of give this medium-term framework a bigger, make it more believable to markets and to people. But perhaps most importantly, we think what's really important is to address these longer-term issues, which are in many cases are entitlement programs, and also health-related spending, which is projected to increase tremendously over the next 20, 30 years. And just as an example of the entitlement reform that we have in mind, the important thing here is to do something that is not going to hurt growth in the short run. And one example is to link the statutory retirement age with life expectancy. This is something that can be phased in. You don't have to do it right away. But if you announce that, in 5 years' time or in in 7 years' time, the age, the retirement age is going to be increased or is going to be linked to life expectancy. This is going to definitely solve some of the medium and long-term problems which you have as a country. So that all of this said, we still think that at exactly at what pace you proceed with the fiscal consolidation will depend very much on country-specific circumstances and the type of credibility which you already have or you don't have. So there are definitely cases where you just don't have a choice. Markets, you're already facing market pressures. And markets are demanding, I mean, interest rates, the type of interest rates which you're seeing on your government bonds have risen tremendously, or they're very high. And we've seen a number of examples of this in Europe, for example. If you think of Greece or Ireland or Portugal or Spain and such. And in those cases, basically the only option is what countries did, which is to do a front-loaded fiscal adjustment to kind of put a down payment on this promise of a fiscal adjustment over the medium run. But for other countries that are not facing market pressures, and actually the bulk of the advanced economies are in this group, they still have relatively low long-term interest rates. Yes, some of them have high levels of debt, and yes, they have issues that have to be resolved. But in this case, the fiscal consolidation can proceed at a more measured pace. And we do think that fiscal consolidation should start in 2011 under our baseline scenario. And when I say baseline scenario, I mean the type of growth projections which we have right now for these economies. By the way, advanced economies as a group, this year we have growth of 2.7, and for 2011 the projection is 2.2. So, and indeed, this is pretty much what countries are doing for the most part. Now, there is an important caveat though. You may have seen in the other analytical chapter which we had in this World Economic Outlook actually looks at the experience of past fiscal consolidations on short-term growth. And what it finds is that pretty much what we remember from our Econ 101 class, that well, basically in the short run the effect is negative. And 1% reduction in the deficit brings domestic demand lower, makes domestic demand lower by about 1. And the impact on growth is a bit small, it's about 0.5, and this is because net exports kind of offset some of this effect. But the other analysis in this chapter, which I think is important to keep in mind, is that the current situation that we have now, in a way, is quite different from what we've seen in the past. There are two main differences. One is that that monetary policy in many of these advanced economies is already near zero. So its ability to accommodate this fiscal contraction is perhaps more limited than it was in the past. And then the second aspect is that now we're in a situation where a lot of countries are faced with the same problem, and they all have to consolidate at the same time, which again, not everybody can rely on net exports to kind of help this, to offset this impact on growth. And as a result, the type of effects that you could see could actually be larger than what we've seen in the sample. Now, on the encouraging part, the type of reforms that I was talking about earlier in terms of the more growth-friendly reforms, in terms of trying to cut entitlement spending, these are not things that had been done in the past. So those sorts of policies could offset and mitigate the impact on growth. But the bottom line of all of this is that I just wanted to convey that there is an appreciable degree of uncertainty about the short-term impact of the fiscal consolidation on growth. And because of that, and because of the general uncertainty that we live with, we think that if the growth turns out to be appreciably lower than what we have in our current forecasts, then the type of fiscal consolidation that is planned right now could be slowed down. And at the very least, countries could let automatic stabilizers work. And in some countries that have small automatic stabilizers, some of the unemployment benefits could be extended. And more generally, if growth is really under threat, then the pace of fiscal consolidation should be slowed down. So this is the bulk of our advice on fiscal policy. Now I can see that I'm running out of time, but I do want to mention the type of policies that are needed for the external imbalancing, because I think they're as important as the internal imbalancing that I was talking about. And there things become even more difficult because there's really no one-size-fits-all in terms of the policy recommendations. So the problem is, as I said before, is that a lot of this demand from advanced economies that was there in the past is not going to be there in the future. So for these economies, emerging economies that relied on export-led growth, well, they may face quite a few problems. So one solution is to shift the pattern of growth towards towards domestic sources. And indeed, a lot of countries, emerging economies, have already done so. If we look at China, for example, we have seen this shift, although it's proceeding slowly, over the past year and a half. We've seen that pattern also in a lot of in India, in Indonesia. We've seen it also in many Latin American economies. But what is really needed here is more of a medium-term shift towards domestic-led growth. And especially in economies where the exchange rate is undervalued at the current levels, we do see a role for increased exchange rate flexibility to help to facilitate that the transition towards domestic-led growth. And in many ways, capital flows that are going to emerging economies are facilitating this external imbalancing. They're going there because these emerging economies are growing at much higher rates than advanced economies. Of course, they're also going there because of the interest rate differential which these economies have. So what's really important for emerging economies is not to resist this rebalancing through excessive reserve accumulation. I mean, we've seen now reserves at a much higher level than they were prior to the crisis, which is quite remarkable. But indeed, to make this, again, a sustainable process, of course, what is very, very important is structural policies. A lot of these changes will not happen overnight. And in many emerging markets, especially in Asia, I'm thinking of China here, increasing safety nets and decreasing the incentives for people to save and increasing the incentives to consume can go a long way in terms of solving the problems. So that's in a nutshell. Of course, there's a lot more we can talk about global policies, but global macroeconomic policies. But what I want you to take away from my talk is that these rebalancing process are proceeding very slowly. And if they don't speed up, and if we don't have the policies, the underlying macroeconomic and structural policies to make this better, we're going to be in for a long haul of again, a fragile recovery with frequent bumps on the road, and also this sort of unbalanced growth which we're seeing right now. Thank you.
Thank you. Now we're going to hear from Mark Weisbrot. And for those of you who don't know him, Mark Weisbrot is the co-director of the Center for Economic and Policy Research. He received his PhD in economics from the University of Michigan. And he has written numerous research papers on economic policy and is a widely cited expert on the IMF, having conducted extensive research on the impacts of their policies around the world, much of which is outside on the table if you didn't have a chance to get it on your way in. So Mark is going to share PowerPoint.
Thanks, Deborah, and thanks to Petya for her presentation and for coming and agreeing to discuss these issues. I think they're very important, and I'm going to disagree, of course. But on what policy changes should be, not so much on the overall situation. Here's the IMF projections. I'll depart from this a lot, but I want to use some of the graphs and slides. So we have not only, as Petya said, a very fragile and uneven recovery, but also a recovery that is slowing according to the IMF projections. And so from 4.8% to this year to 4.2 for next year. That's the latest WEO. Now, the WEO itself also says that, as Petya pointed out, that private domestic demand is weak. It remains weak in many advanced countries. And, you know, the United States and Europe are, let me stick on this for a little bit, are half the world economy. So they have an enormous impact. And the U.S. economy is weak, is very weak, a very weak recovery right now. And I mean, I'll just give a very quick couple of numbers. You know, we had an enormous housing bubble, probably $8 trillion of overvaluation. About $6 trillion of that has disappeared. And we had, you know, also a commercial real estate bubble, and we had a stock market drop as well. And combined, just by standard calculations based on the wealth effect, we would expect about $600 billion decline in private demand annually from that, and another $600 billion from the loss of construction, which is actual. Okay, so that's 1.2 trillion fall off in private spending in the economy from just the collapse of these bubbles. Now, the stimulus package that we had to counteract that the Congress passed, if you take off the state and local government spending, which goes in the other direction in tax increases, and so you look at the net effect of government, you're talking about $150 billion a year for 2010 and 11. And so you have really 1/8 of the stimulus that you would need to counteract the fall off in private demand. So unless the dollar really crashes and we get a huge increase in net exports, and we can talk about the WEO projections as the WEO Chapter 3 on the effects of fiscal consolidation. But unless something really like that happens, we're talking about a prolonged period, which of weak growth and very high unemployment. And of course, the CBO and both CBO and the White House project prolonged high unemployment. So not getting back to pre-recession levels of unemployment until 2018 for the White House. These are enormous social costs. So we really should be careful about this. Okay, when we're talking about a fragile and weak recovery. Petya says, well, we can go back if it turns out to be worse than we think. Well, that's not always so easy. Recessions have a cumulative effect. And if we go back into recession, for example, it could be harder to get out of it. So I want to emphasize that. The U.S. economy is fragile. The Eurozone economy is slowly recovering and also fragile. And that is half the world economy. And so I think there's a contradiction between the WEO's overall outlook on the world economy and the advanced economies and the policy recommendations that we just heard. Let me go forward some more and take a look at this. Oh yes, I'm changing them. Okay, this is another quote, and this is what Petya already described, so I won't go into it, but one thing I will say is that I would take the second number that you used, the 1% cut in fiscal consolidation leading to 1% of GDP rather than half, for the reason that you said. everybody's not going to be increasing net exports at the same time. And if you're talking about the worst counter-cyclical cases, for example, the Eurozone, weaker Eurozone economies, they're stuck in the Euro, so there's nothing they can do in terms of trying to get out of, export their way out of the low growth. Now this study we did at the end of last year, and this just shows that, you can hardly see it from there. I'm just going to pass over it quickly, but just to mention the main conclusion, we looked at 41 agreements for the IMF these were the agreements made during the recession, 2008 and 2009. 31 out of 41 had either contractionary fiscal policy, or contractionary monetary policy, or both. And this was by a conservative measure of measuring the fiscal policy stance, because we didn't have structural budget estimates. So in other words, normally you want to look at you don't want to just look at what happens to the budget balance, because our deficit will increase, for example, because of automatic stabilizer. So you want to adjust for what the budget balance would be in full employment. And we didn't do that. So it's worse. The actual picture is worse than that. Now the question is, well, what's happening today? And these were major mistakes. And we went through this already with the IMF, and they have their answers, and you can see the whole debate. We put it all up on the web. But to be fair, the IMF did exactly what Petya talked about. Some of the agreements were made in 2008, and there were reviews for 2009, and they did change their policy recommendations and agreements, the policy in the agreement, their macro policy in the agreement. So the recession turned out to be a lot worse than they thought, which is exactly the risk that we're looking at going forward. Okay, and personally, I think they should have known. At that time, it was pretty obvious. Right now, we don't know. We know that there are a lot of downside risks, but it's not like in, these agreements that were being signed in 2008 when, the housing bubble had burst, and it looked like you knew that bad things were going to happen. And their projections for 11 out of these countries were more than 3 percentage points over-optimistic. That's one of the ways in which the IMF ends up making these, inappropriate macroeconomic policies. They have over-optimistic projections. They say, oh, you can cut the budget, you can tighten monetary policy, because their growth estimates are way off. And by the way, again, in fairness to the fund, I want to say that all the criticism I'm making of the fund are really criticisms of their directors. Okay? I'm not blaming the fund or its economists in general, because they are run by the U.S. Treasury Department and with some input from Europe. And in some cases, the European governments are much harsher. In the case of Latvia, which I'm going to mention, the EU was clearly responsible for that mess, and more than the IMF. On the other hand, the IMF has quite a bit of influence, does research, and also provides funds and signs off on the agreements. So they have to be considered responsible, but it is their directors. And one caveat I'll make to that is that, since I already mentioned the U.S. economy, Olivier Blanchard, the chief economist of the IMF, was quoted in the newspapers yesterday, and whenever I see quotes in the newspapers, I always have to put another caveat in, because they're not always accurate. But if he did say what they said, that the United States does not need a further fiscal stimulus, that's something I'd love to have him in this room try and defend, okay, given the actual numbers that we just went through, that this economy doesn't need another fiscal stimulus. I'm amazed that he could say that. Even after his paper, the Rethinking Macroeconomics paper, which he published last February, where he, said, for example, and this is going to be relevant to what we're talking about, that central banks could possibly revise their targets from 2% to 3 or 4% inflation. So this is a major break for which he caught a lot of grief, break from orthodoxy, central bank orthodoxy, and I don't understand how the fund, and Petya, you're of course welcome to respond if you want to defend that statement, but this is really, in the world's largest economy, I think that's a very wrong belief. The other thing I think is really wrong is this focus on entitlements, and this is very easy. So the IMF is saying, in their WEO, that you have to put forward, as Pet just said, a credible long-term plan or intermediate-term plan for reducing, for fiscal consolidation, and part of this is reducing entitlements, raising retirement ages, and so on. And of course, we have this deficit, this commission in the United States, which is going to look at the long-term deficit problem. And this could be refuted in just 2 sentences for the United States. Number one, well, at least 70% of our entire long-term deficit problem in the United States is just healthcare costs, okay? And so in other words, if you go to our website, you can plug in any other rich country's healthcare spending cost projections, and you see that the U.S. deficit eventually turns into a surplus, okay? So this is the problem in the United States. It's not demographics. It's certainly not Social Security, which has a very small projected shortfall that is just not even a problem, and can be reconciled very easily, as it has in the past, with relatively small tax increases. And so this is, I think, a dangerous kind of view to put forward, that entitlements in the rich countries, and especially the United States, are the problem, or that there's other structural problems like that. Okay, let's go forward here. Now, these are actual pro-cyclical policies in which the fund is involved. They don't have agreements in all these countries, but they're involved, for example, in Spain and Portugal and Ireland as well with the European authorities. And these are countries that, Hungary, okay, has slight positive growth, but the others are negative, and they are engaging in fiscal tightening, that is, cutting budgets, raising taxes. That is what we call pro-cyclical policies, the ones that Petra mentioned, that are guaranteed, as a matter of national income accounting, to push the economy further down. Okay? Now, that is, I think, just wrong. And again, Petra mentioned, well, there's maybe no choice. I want to argue that, in fact, there is a choice for all of these countries, and we'll get to that towards the end. But this, I think, is very wrong. Once you go down this path, you don't know where it's going to end. Latvia is the worst case. Well, we can take Greece first, just in order here. Here's the consolidation of this, just shows their budget deficit being reduced, okay? And this is a case where maybe they have too much debt. It may be that they need a restructuring. If the IMF projections turn out to be correct and their program works, Greece ends up with 144% of GDP debt just a few years from now, as opposed to, they started out with 115. So this is not a program that seems workable to me. And if, in fact, as the markets believe, with a 75% probability that Greece is going to need a restructuring, well, then it's better to do it now than to make this country suffer for several years and suffer. Where do they get back to their pre-crisis level of output? Not even in 2015. And here's the IMF projections for Greece. Notice the difference between the October and the April wheel for Greece. Turned out to be a lot worse, huh? That's what happens a lot of times in these cases when you start to use pro-cyclical policies, because a lot of course, investment, consumer spending is psychologically affected, and you don't know, again, how far down it's going. The dotted blue line underneath is the most recent projections for Greece's negative economic growth, and the other one is the April. And of course, there's the cost in terms of unemployment, not nearly as bad as we'll see some of the others. There's Greece. That's the inflation rate, which we can see inflation is not a problem at all, which is going to be important when we talk about alternatives. Ireland also, big fiscal consolidation, economy shrinking, again, unemployment rising from below 5 to around 13%. And again, they have deflation now. So there's another country that could very easily have expansionary fiscal policy, even paid for through central bank financing without any worries about inflation, if there were monetary authorities who were willing to cooperate with that. Latvia is the worst. I want to emphasize this because this is a case, as I said, where the European authorities are worse than the fund. But this is a case where they lost, this first one shows their fiscal consolidation taking place. Economy's already lost more than a quarter. The country's lost more than a quarter of its GDP. We still have projections that get them back to their pre-crisis level from the latest WEO, even after 2015. And look at their loss of output here. Look at the second to the bottom bar, over 25%. Worst, only thing comparable is the United States Great Depression years, 1929 to 33. This is in 2 years, they lost that much, and they're still shrinking this year. Still no light at the end of the tunnel. Why? Because they're going through this process, again, which the European and the authorities and the IMF signed off on and provided billions of dollars for, where they're shrinking the economy in order to conduct what's called an internal devaluation. They want to keep the currency fixed, and they, in order to do that, they have to basically shrink the economy enough so that they become competitive on the basis of lower real wages and therefore a real devaluation with a nominal exchange rate fixed. A very brutal process, one that was tried with the same effect. You can see the next worst crisis there was Argentina, where they tried the same thing from 1998 to 2002 and ended in disaster. So again, these are examples of pro-cyclical policies that I think are really wrong. There's Latvia's unemployment rate, and they've lost probably 10% of their population. People are just leaving the country because they can't find jobs. Again, lower negative inflation. Okay, Portugal, it's a similar story. I won't go through all of them. Romania, again, fiscal consolidation, while the economy is in recession. Well, it's barely growing. We saw 0.6. Here is Spain, which is going to shrink about 0.3% this year, also engaging in fiscal consolidation. Another mistake. And look at their unemployment, over 20%. Is there really nothing we can do about this? We actually did a paper where we looked at the possible alternatives. And you can see the baseline scenario. You can just see the arrow pointing to it. That's the IMF projections, and I'm sorry, that's the Central Bank of Spain projections for the debt to GDP ratio, and that's if, of course, everything works. If it doesn't work, then you have lower growth. If they end up having to pay a higher interest rate because the markets don't really accept that they're adjusting fast enough, you have a much bigger, huge debt to GDP ratio. We did two other scenarios. One where you have a stimulus instead of cutting spending and raising taxes, and you see you only get 4 percentage points more of GDP, 4 percentage points of GDP debt at the end of 10 years than you would have under the consolidation scenario, which is not working very well right now. And then another scenario we had, which is the blue line at the bottom, which you end up with lower debt and, of course, much higher growth, where you finance it through the central bank if the ECB were to cooperate and do what the kind of things that the U.S. central bank is doing. Now, this is what I want to talk about because I think it's very important. These are the alternatives. They're not pie-in-the-sky alternatives. These are reasonable alternatives. What can you actually do in countries that don't want to accumulate more debt? Now, first of all, it's only net debt that matters. Okay, everybody should understand that. It's a little misleading if you read the press and all the discussion. They're almost always talking about gross debt. But if you have debt that is owed to the central bank, you're getting interest on that debt. It goes back to your treasury. Okay, in the United States, for example, because the Federal Reserve has created over $1 trillion since the recession started in money creation. Okay, they mostly bought mortgage-backed securities, but some of it was also buying federal government treasuries, and they could have bought all the treasuries. It has the same impact in terms of the money supply. And they get now, for 2010, the Congressional Budget Office projects that $77 billion will come back from the Federal Reserve back to the Treasury because of what they're holding. So that's about 37% of the net interest burden of the United States. It's a significant amount of interest. So you see, when the central bank owns the debt, the interest payments come back to you, to the taxpayers, to the budget. Okay? And so when you add that kind of debt, you have no additional debt burden. Japan, for example, has over 220% of GDP debt. That's their public debt. Now, over 100 percentage points of that are owed to the central bank. That's one reason why Japan doesn't have a fiscal crisis, in spite of having, an enormously bigger debt than Greece. The other reason, of course, is they can borrow at 1% on a 10-year bond. But that's another part of the story. But the main part of the story is that they added literally trillions of dollars of public debt in the last 20 years by borrowing and financing it with their central bank. Everybody knows this. What was the impact of this on inflation? Well, inflation for the last 20 years in Japan, cumulative, not annual, but for the entire 20 years, prices have gone up 5%. Okay? So this did not lead to inflation. And it will not lead to inflation in the United States. There are people, and there are people I've talked to at the fund, who actually believe that the money created by the Fed in the last 2 years is going to suddenly lead to a burst of inflation. I will bet you large amounts of money that that will not happen, because it doesn't happen all at once, okay? The Federal Reserve will be watching, and if, in fact, the inflation starts to pick up, long before it's appropriate, probably, they will be tightening monetary policy. But in any case, it is not a threat. And you can see all the countries that we looked at, they all had low inflation or even negative inflation. They all have the option of, if they had a central bank that was willing to cooperate, of financing expansionary fiscal policy and doing it the same way by creating money the way the United States Federal Reserve did. Certainly the European countries could do that. Now, the problem, of course, is different for low and middle income countries, and I want to say a few words about that, because that's also part of the problem, right? Some of those are engaged in fiscal consolidation. Now, I didn't really spend any time on this because it was right at the beginning, but for the low and middle income countries, you can see a lot of them represented here in this graph. Can you see it? These are all countries with IMF programs. And you can't read them, but the majority of them are tightening. Okay? They're engaged in fiscal consolidation now, from 2009 to 2010. Now, I showed you that in the past, a lot of these were pro-cyclical policies. Most of these are no longer pro-cyclical. Some of them are, okay? Why are they mostly not pro-cyclical anymore? Because these economies are rebounding, right? The emerging market, the developing low and middle income countries are mostly coming back. But that doesn't mean they necessarily have to tighten, they have to cut spending and raise taxes as much as they're doing. So they also will be facing problems, and especially if the world economy weakens. And so for the developing countries, and of course, if the rich countries, if the U.S. and Europe follow the fiscal consolidation that some people are recommending, these countries will take a hit, just as they did during the last recession. So what can they do? And I just want to summarize this quickly, because this also is often misunderstood. For the low and middle income countries that don't have a hard currency like the Eurozone or the United States or Japan, they can, in fact, engage in expansionary fiscal policies so long as they have enough foreign exchange. In other words, the real constraint for them is a foreign exchange constraint. When their economy grows, their imports grow, their current account balance can worsen, and they have to have enough foreign exchange to be able to do that. And in my view, the purpose of the IMF in these countries is to lend them the foreign exchange that they need so that they can do what the rich countries do when there's a downturn, and not have to do what countries did in the 19th century when they're on the gold standard or something. Actually engage in pro-cyclical policies. And to its credit, the IMF actually created in 2009 $285 billion worth of its own reserve currency, the special drawing rights. And this was a very positive step. This gave countries more reserve. This is something the IMF could do again, and I think to help to at least provide some further liquidity to developing countries that need it. Okay, I will stop there. I think we've both taken about the same amount of time, and we can answer any questions. Thank you.